Well, good afternoon, everyone, and welcome to the co-hosted event of the Actuaries Institute and the Australian Institute of Company Directors. Our theme for today's webinar is Insurance Company Governance, Navigating COVID-19 Stress and Uncertainty. Welcome to the members of the Actuaries Institute and to the members of the Australian Institute of Company Directors and other guests. We will be recording this session for later viewing on both the Actuaries Institute and AICD websites. My name is Annette King and I'm delighted to be your chair for today's webinar. I'm the Vice President of the Actuaries Institute and a Fellow of the Australian Institute of Company Directors. I'm a Non-Exec Director at Swiss Re, FNZ and Galileo Platforms. Well, welcome. We are certainly in extraordinary times. In Australia, we started the year with bushfires, storms and cyclones, and then COVID-19 hit. And we've had our first truly global pandemic for decades, and some would say the worst in 100 years since the Spanish flu. It spread quickly all around the world. Until today, we have over 7.6 million recorded cases and over 420,000 recorded deaths. And we all know that the recordings are only the tip of the iceberg. We're dealing with both a medical challenge and economic upheaval. Actuaries have a strong history of working at that intersection of human demography and economic uncertainty and opportunity. And board directors have clear and well-defined responsibilities, but executing on them in uncertain times is very difficult. Today's session is focused on helping insurance company board directors understand how best to work through those uncertain times and to move through survival mode in the short term to focus on recovery and optimizing their opportunities on the horizon in the eventual new normal. These times certainly present many issues for board directors and those who advise them. But challenge brings opportunity, so we'll be talking about how best to position to create growth options in the new norm. Today we have two sections over the next 1.5 hours. The first session is focused on board governance from the perspective of the board chair and the chair of the board risk committee. The second session is a panel of industry experts who will speak about capital, risk, uncertainty, and opportunity. There'll be 2 polls during the session for you to have your say, and there'll be Q&A opportunities from the audience. So please post your questions during the session and upvote other people's questions using the thumbs up icon. At the end of each of the 2 sessions, we will endeavour to select the best questions to pose live to our panels. So let's start by welcoming our 9 esteemed insurance professionals, moderator Ian Lachlan, our first speaker Duncan Boyle, our second speaker Nicolette Rubenstein, and our panellists Kent Griffin, Tim Clark, Winley Toe, Andrew Matthews, Greg Martin and Anton Capel. Turning first to our first session on governance, let's welcome Duncan Boyle, who has decades of experience in the insurance industry, both life insurance and general insurance, in Australia, New Zealand, the UK and Europe. He has seen many challenging times in the past and he'll share his pearls of wisdom. He's chair of TAL and a non-exec director and the chair of the risk committee at IAG, and he was previously a non-exec director at QBE. Nicolette Rubenstein has diverse experience as an actuary in financial services and now a non-exec director at UniSuper, Zurich, OnePath, Class Limited, CBHS Health Fund and SuperEd. Last year she was the president of the Institute of Actuaries and now chairs 3 audit committees on her various boards. Sorry, chairs 2 audit committees and sits on 3 risk committees. So Ian will be moderating the session. He has 40 years of experience in executive and non-executive roles in a number of countries, including chairing a number of insurance company boards and being deputy chairman at APRA. We're going to conduct the first of 2 polls so you can have your say. Simply click on the box with the answer that appeals most to you. And our first question is appearing on your screen now. Do you think that a year from now, your company's strategy will be different from what it was in January 2020? So please just click on yes or no, and we'll see the results come up very shortly. Okay, so we see that 75% of people think that the forward strategy will actually be impacted by COVID. I guess not that unexpected. 25% interestingly think that it won't be impacted. Just to share with you, yesterday the AICD released their member survey on the COVID-19 impact. We'll post the link a little bit later to that survey. There were a number of issues identified for the next 6 months, being cash flow, customer demand uncertainty, pivoting business and adapting to new ways of working. But your results today are also indicating that there will be longer term impact on strategy, and so we'll be discussing that. And with that, I will pass to Ian to speak with Duncan and Nicolette.
Thank you very much, Janet, and welcome and hello to you both. Let me start with Duncan. All those long years of experience, Duncan, you have seen quite a few episodes of stresses and strain. You know, think back to the 70s economic woes, the 87 share market crash, the Asian debt crisis, the tech wreck, 9/11, Lloyd's under stress, the GFC. They can't all be 1 in 200 events, by the way. But what's different? What's different about this particular one?
Yeah, so 48 years in the industry, you see a lot of incidents happening. Everyone's different. I think if I reflect on 9/11, I was chairing Global Aviation Underwriters at the time. It was about getting the airplanes running again on Monday with reinsurance in place. With the London bombing, it was about staff safety. I think where COVID-19 is different, its scale is just out of any league that I've previously experienced in my career. And it's affecting everybody's lives, all staff, all customers, and every business. And that's unheard of, really. And I think the impact is profound for everybody.
So how important is preparation for an unexpected major shock for an insurance company?
Yeah.
And how specific should that preparation be? Because you obviously can't predict where these things are coming from.
Yeah. Well, look, I think all companies prepare for instance generally. We all have our disaster recovery and business continuity plans. We have lists of contacts, we have structures that we can put in place, and we have alternative premises lined up, etc., etc. But the reality is, in my experience, that when it happens, you just have to get on with it as a board and executive team. Roll your sleeves up and start looking at the incident, but in a specific way, looking at the real circumstances that you're dealing with. And all that background planning is there to fall back on if you need detail. But frankly, I can't remember ever looking at it when you've actually got involved in these incidents. You are really just getting your executive team together, getting your board together, and getting into the issues that you need to face into.
And we'll touch on some of that preparation required by regulators in a minute.
Yeah.
So under stress, though, is there a danger of making decisions without adequate knowledge? You know, when you gather that management team together that you just referred to, and there's a lot of uncertainty, and you feel the need to do something. So is that a risk?
Yeah, look, I think the risk is the alternative risk of not acting quickly enough. And I think you've seen that from government. That our government fortunately responded very quickly, and I think we're seeing the benefit. I think we're seeing in countries where they haven't acted quickly enough, the consequences have been dire. And I think the same applies for companies, boards, and executive teams. I had an incident early in my career with the Newcastle earthquake where I was a young manager, and this is in 1989, and I felt on reflection after the event that I didn't react strongly enough, and that was a lesson to me. I think, you know, when these incidents happen, staff want leadership. They want to know what's going on. They want their safety looked after in an incident like this. Customers need a response. And from a board point of view, very much you're looking at the financial security of the business, the capital position, the stress scenarios. All of this stuff needs to happen quickly. It's going to be done on imperfect knowledge, and that's the reality of life. You just have to get on with it, and you know, you have to take those uncertainties into account and then just build on them over time.
Yeah.
So both my companies moved very quickly to protect staff, and I think as a reaction to that, we've seen a very positive response from staff.
So some companies will have been well prepared for a shock like COVID-19 and responded according to, you know, business continuity plans and ICAP and RAS and the risk management strategy and so on. Others might have been much more ad hoc and reactive. So what are your observations on the merits of a structured approach to major risks and uncertainty? And I guess, do those pesky regulatory requirements, do they actually add value?
Yeah, look, over my career, I've seen regulation have a big impact on the financial services industry. And I think, to be frank, it's made it much more professional when it comes to capital and capital resilience, stress testing, and preparation around RAS and so on. So I think that is necessary, but not sufficient for what we need here. Because, again, when these events happen, do you go running to look for those things and to give you a guidebook as to what to do? You know, you're actually diving into, again, the issues that you're confronted with, and probably redoing stress tests, which will probably challenge your the stress tests you've done in advance, because you never quite anticipate what the true situation is going to be when you're faced with it.
And we'll pick that issue up actually with our panel a little bit later on. So the insurance industry's got considerable trust issues with the community for a variety of reasons. We saw that with Royal Commission. But we've also seen the banks use the COVID world, the environment, to recover, to regrow trust with stakeholders because of some of the actions that they've taken. And ASIC has made it clear that they expect customers to be well looked after and potentially beyond the contractual obligations of the institution. And even in the US, we've seen some states with legislation overriding the contract. And so do you think the insurance industry here is doing enough regarding community expectations in this COVID world? And, you know, how do you get a balance of that contract certainty and pricing with customer expectations?
Look, I think both in the life and the general industry, boards and management teams are trying very hard to justify the trust that customers need to have in us. And, you know, if I look at IAG, the response to the bushfires and some of the events over the end of the year, you know, I'm very proud of. But I think we have to make judgments as boards that balances the survival and the well-being of the business against customer expectations. And if we are going to see covers push beyond what was intended and priced for through action by governments, that's quite worrying, and I think needs to be resisted strongly. I think, you know, just as an example of where we're with, you know, competing pushes and pulls as well, those involved in the life industry would know around disability income insurance that we have APRA pushing us to remediate the business, to get it back in a good state. They're putting capital charges on the industry, which has been temporarily suspended, but will come back. And on the other hand, we have ASIC pushing us to pay more and more claims, to be more generous. So it's a difficult balancing act for management teams and for boards, and to exercise good judgment around how that plays out. And at the same time, I think looking forward into a period over the next few months when there will be a pressure from customers and regulators and the media for us not to be putting price increases through. But there are, we have a life industry that's under extreme pressure, losing money across the board, and price increases are inevitably going to have to be a part of fixing that problem.
Yes, too true, I think. So COVID-19 has thrown many plans in the air, of course. Management and board have been forced to focus on the immediate issues, but strategic and operational matters for the emerging world also have to be addressed. So how does the board go about, board and management, balance the need to deal with the short term, the immediate issues, and also monitor and work your way towards the longer term position that you think the company needs to be in? And in answering your question, I'd be interested in your thoughts on thinking about three horizons. The very short term, the medium term, where you're helping the business to recover, and then the longer term, which is really where you really want to be from a strategic point of view, given the events that have happened. So,
yeah. So look, I think both my boards have been similar in this regard. That the here and now, the first few weeks was very much about moving into a war footing, about dealing with issues around staff protection, dealing with how we got messages out to customers, how we got the initial stress testing done around capital, making sure that was secure, talking to regulators on a very regular basis to make sure that we were in step. So all of that necessary stuff that's around the very much the here and now. But I think very quickly both companies also realised the significance of implications for future strategy, and some of the lessons that we were learning out of what was happening in the first few weeks was going to impact very much on the future. And there were severe implications as well for business volumes, for example. So very quickly moved into setting up steering committees for strategy planning to review some of the outcomes of what was going on and where we needed to move.
So let's just move to business models very quickly. We've got a couple of minutes before we move to Nicolette. So over the last couple of decades, there have been more and more outsourcing and offshoring and so on, with reliance on specialist partners in the value chain. So what is the global work from home, remote working environment that's followed from COVID, and the financial stress on the different parties in the value chain? What does that mean for future business strategies? Can you see significant changes happening in operating models, target operating models?
Yeah, I think so. I think this is a fascinating area for us all to look at fresh and reevaluate business models and working practices. I think arguably offshoring was already starting to be challenged by robotics and digital, plus the cost dynamics are not quite as clear as maybe they were when I was setting up call centers in India 25 years ago. But CV-19 has also thrown in another dynamic on the offshoring, because the resilience has clearly been found wanting compared to onshore. So that's an issue for us. I think also the working from home. IAG already had a large working from home workforce, and by and large staff love it, and productivity is good. So it was very easy for IAG to swing into 100% working from home. So did TAL, and the impact on employee NPS has been amazing. It's through the roof in both companies, and I'm sure others have got the same experience. And I think we've also seen productivity improve. Now, whether that is a temporary thing or whether it's a long-term thing, I think needs to be played out. I have a personal view that it's probably a long-term thing, because I think people adjust their lives and make it work better. So there's a lot to be thought about here. There's also lots to be thought about the risk that we've thrown into the scenario through data security and cyber being weaker protections in our working from home environment, and how we strengthen that going forward. So a lot to think about operating models for boards and management teams.
Yeah, certainly are. So one very quick question, and I'll be brief. across the economy, of course, there's been a significant shift to online commerce purchases and that sort of thing. And including, older people all of a sudden becoming Zoom users and purchases online using all sorts of things that they never thought about before. And activities like face-to-face sales and claims assessment, health assessments moving online. So significant changes in a very short period of time. How do you see that playing out in the insurance world?
Yeah, look, I think you're absolutely right. Digital was already growing fast, but I think it will be accelerated by this. And I think that's a great thing because, frankly, call center operation is a horrible aspect of our business. When you've got 30, 40, 50% turnover rates in call centers around the world, it's not a great business model.
Yeah.
So moving down the digital path, I think is great at pace. And I think it has to be around not just the sales process, it's got to be about how we service customers. And I think too many companies just focus on the sales side. I think the issue for life insurance is that we've seen a collapse of sales through regulatory action over the last 18 months to 2 years. And we're in danger of entering a phase where there is the insurance sold other than through group. And that is not helpful. And I think life insurance has to be sold, not bought, unlike general insurance. And that's, I think, from a digital point of view, is not easy to achieve, as we found.
Yeah, no doubt changes are necessary, but as you say, very hard to understand how that might play out. Nicolette, can we turn to you, please? So a shock like COVID-19 certainly puts the spotlight on risks and risk management. So as you reflect on the pandemic to date, and as chair of board audit and risk committees across a couple of different industries, so what are the main learnings for you?
Thanks, Ian. Hi, everyone. The first learning has been how to use online meeting software. And I've managed to show my bare feet on 2 occasions to the UniSuper board. And I think that goes under the category of personal reputation risk because the camera was pointing the wrong way. Anyway, on a more serious note, the first observation has been around operational risk. And Duncan touched on this, but the move to working from home has been surprisingly smooth across all of my boards. And that's something that I wouldn't have expected. Now, I'm sure if you ask the Chief Operations Officer or the CTO, they wouldn't say it like that. There was a lot of work that went on behind the scenes. And there's no doubt that some of my companies were more prepared than others. So some companies that were already using the online meeting software, companies where all the staff already had a laptop, were better prepared. But overall, it's amazing how little board time that massive process has actually taken up. And it has actually highlighted a number of big opportunities for the future. And Duncan mentioned the working from home has gone surprisingly well. Productivity has lifted in places. Service levels, service metrics have lifted. And I've even heard it mentioned, do we actually need a BCP site? Given, we've proven this working from home model so quickly. So there's quite a lot of learnings in that. The second learning is around insurance risk. And from my point of view, the pandemic's had a very unexpected impact on insurance risk. So in health insurance, for example, claims have actually reduced in the pandemic. In life insurance, because of the interaction with an economic recession, it's likely that we're going to have increased morbidity claims rather than mortality claims. I think that's probably a surprise for a lot of people. And general insurance, even, it's sort of been very variable. We've had a massive impact on travel insurance, and yet claims under, say, car insurance are lower. So, the whole impact on insurance risk has been not what I would have thought. And my final learning is around ICAP and its usefulness. And funnily enough, again, it's not been useful for the reasons that I thought it would be useful. You thought you might be able to go to the section on pandemic risk and the scenario on pandemics and open it and sort of get a nice prediction. And that's not been the case. You know, the pandemic, we didn't predict that interaction with the recession and the economic scenario. But the ICAP has still been incredibly useful. You know, first of all, actually the underlying modelling, at a very early stage, we could go and tweak some of the modelling and get a bit of a read on, you know, what things might look like. Interestingly, the scenario on economic recession in our ICAP ended up being a much more useful one than the pandemic scenario. And also just the fact in the recovery plan that we'd articulated actions, I think that was a good sort of go-to list. So yeah, the ICAP's been useful, but not for the reasons we might have thought it might be.
Okay, so well, there are some lessons in there too for the future.
Ian, it's Annette. Hi again, everyone. Can I just interrupt to encourage everyone to start posting questions? At the bottom of your screen, there's a black bar and there's a Q&A. If you can click on that and post any questions, we will have a session at the end with Duncan and Nicolette where we can ask them some live questions from the audience. Thank you.
Okay, thanks, Annette. Nicolette, Board Risk Committee and management relationships, including a respect for their various responsibilities, is critically important at the best of times, most benign of times. And so how might the relationship change under stress and uncertainty such as we've got at the moment? And what advice do you have?
Yeah, I think that what happens now very much reflects the work that you've put in, you know, in the years coming up. And, you know, do you have the right governance structures in place? You know, have you got really skilled, experienced management team? And probably most importantly, those relationships with management and how quickly you can pick up the phone and have a conversation. And, you know, fundamentally, I think it comes down to trust. And last year at the ASFA conference, we had Steve Covey present, not the famous Steve Covey who wrote the 7 Habits of Highly Effective People, but his son, who's written a book called The Speed of Trust. And it very much reminds me of that now, because when you've got those trusting relationships, you can have much more open, quicker conversations and make better decisions. And I'm reminded about a meeting I had with our actuaries where, you know, they took me through the assumptions, they took me through what research they made their assumptions on, and they took me all around through all the issues. And at the very end of it, they just said, you know, you've got to know this is our best guesstimate. And I just thought that was so good because it reflects that trust that they could say to me, you know, we've put as much science as we can behind this, but at the end of the day, this is a guesstimate. And, you know, that reflects, I think, the trust and strength of relationships under pressure.
Yeah, that's a really interesting message for actuaries, I think, who can sometimes get lost in the mathematics. So I guess a related question, what can you as the chair of the risk committee do to develop and maintain the most effective relationship in these circumstances? What do you do practically?
Yeah, so as I said, I think you need to put the hard work in up front. I think staying in contact at this point is vital. So, you know, for example, I'm having weekly phone hookups with our CFO, regular meetings with Chief Risk Officer and the appointed actuaries. I think the value of behind the scenes discussions comes even more to the fore. So making sure that you're all on the same page before the meeting so that the meetings go smoothly. And just from a chair point of view, just getting the basics right, making sure that you've discussed the agenda, that the agenda's the right, you've got the right things on there, you've allowed enough time, you know, these kind of times. I'm sure everyone else had this, but we had a lot on our agenda and we struggled with the timing of some of the things. So, you know, you've really got to think those through. I think from the chair's point of view, you've got to make sure that you get the information flow right. So are your committee members getting the information they need? Have they got the background papers they need? And from a chair's point of view, it is incredibly valuable when the paper that comes to the committee nails it and has a, very thorough, well thought through recommendation. And also where that has been socialized with the management team. That really is gold in that situation, because otherwise there can be a lot of toing and froing in the meeting.
Duncan, just to go back to you very quickly, how has your interaction with management changed during this period of time?
Well, look, I think most boards in financial services over the last couple of years have had a rapidly increased rhythm of engagement with the exec team because of the Royal Commission and APRA review and so on. I think that's really carried on in an even more heightened pace through the pandemic, and very regular meetings, very regular catch-ups from committee chairs to their counterparts and so on, as Nicolette was talking about.
Okay, thanks. Nicolette, observations on the skills and experience needed by the risk and assurance experts you deal with, and are they any different in these sort of circumstances? Like this is a real life stress test. Do you see any need for different skills, more greater skills?
I've been very thankful for the depth of actuarial capability that we've had in our management team. So we happen to have a CRO that's an actuary, a CFO that's an actuary, and we also happen to have, because we've brought two life companies together, we've got two appointed actuaries as well. So I've been very thankful. Our CRO has been a CFO and has been an appointed actuary. So a lot of depth of experience there that's been very valuable. And even having two appointed actuaries at the moment, it's been interesting. They've got very different capabilities and styles, and it's been good to see them bring their collective brains together and arrive on a agreed recommendation. I found that very useful. In terms of the skills that you need now, there's a couple that do come to fore. The one is actually just interpersonal skills, and under stress and in crisis, people people show their true colours, and probably what's going on with Donald Trump at the moment and how he's reacting under pressure, blaming people, criticising, anger. So I think you value people who are calm under pressure. And the other one is communication skills. And I had a bit of a scan of some of the boards of the big insurance companies in Australia. And in some ways, there's fewer actuaries than you might think. And what that made me think is actually that what's very important is the communication skills of your actuaries and your ability to present to a non-actuarial audience under these situations, because there's complex scenarios that are unfolding, a lot of uncertainty. So, I think, in terms of talking about additional skills needed in this time, those communication skills have become vital.
Yeah, okay. One more question before we open it to questions from the audience. How important have the risk management strategy and the risk appetite statement proven to be in managing through the COVID world so far, and what have you learned from that?
Yeah. When I first saw this question, I didn't actually know how to answer it. There's no doubt they've been valuable, but I wasn't really sure how to articulate it. And I did go back to the guys at Zurich and kind of talk to them a bit about it. And our CRO actually put it very well. And it's actually about the embeddedness of the risk management framework and the maturity of the risk culture. And I think that's it. That's actually what's allowed us to manage through to date. And what the risk management framework gives us is actually a document, a set of metrics, a language that we can have, that we can all use when we come to discuss this, and these metrics that we can refer to. And We even actually referred back to a statement in our risk appetite statement about taking on insurance risk that is measurable and understandable. And, we actually adjusted our actions accordingly. Having said that, another point that was made was, if you expect your risk appetite statement to have triggers in it that react to these black swan events, that's not going to happen. Your risk, your metrics would be as long as there'd be a book of them, basically. So looking for particular triggers, I don't think that's where you should be looking in this situation. And as I mentioned before, actually, for the finance guys, it was actually the ICAP document that was most useful. And even from a board point of view, we referred to that a lot as well. And because it had the scenarios and because it had actions in it was what made it valuable.
Okay, thank you. So, Annette, can I hand over to you just to pick up some of the questions from the audience, please? And the audience will have a chance later to ask questions of Nicolette and Duncan.
Yes. Okay, there seems to be a lot of interest from the audience in the work from home and the productivity improvements that both Duncan and Nicolette have spoken to. One of the questions is, what are the metrics being used by organisations, and are you seeing the same productivity uplift in all functions? So Duncan, can I ask you to answer first, and then Nicolette?
It'll be a short answer because I don't have that information, I'm afraid.
Okay, Nicolette, do you have any metrics that your organisations have been using?
Yeah, some of them were like call centre metrics around number of calls taken. Some of them were net promoter scores on calls. The other anecdotal one was more anecdotal than it was a metric, which was actually productivity of software developers, so more in the technology area. And by the way, it hasn't been universal, so I should point that out. There's just been pockets of areas that have seen a productivity increase. But, I think it shows there's some opportunity there.
Thank you. Yeah, I work in a couple of tech companies, and they've both seen productivity improvements in the coding and developer space. Second question is around our natural disasters, particularly the bushfires and floods, and the differences in definitions between the different companies. So the question is, how do you think that the standardization of insurance terms and exclusions will play out? And can we do more as an industry to assist the community in understanding what they're covered?
Yeah, look, I think in terms of some of the debate around the definitions of what's happening in the bushfire losses, there is scope for the industry to work on, and in fact the industry is working on that. It's an interesting one though, isn't it? Because coverage is an area of competition as well. So how far do you go with this in terms of making everything standard? From a commercial insurance world, which I spent most of my career in, there were standard contracts at one stage, when it gets broken down through competition with broker wordings and so on. I sometimes think differentiating through policy wordings is just complicating things for customers. Rather than simplifying it. That's an area that we need to think about, because I think one of the issues for customers that hasn't been cracked throughout my career is, how do you get customers to simply understand what they're buying? Simple wordings, PDSs, etc., but people just don't read the stuff. So how do we get people to understand what they're actually covered for? It is an ongoing conundrum for the insurance industry.
Thank you. And one final question to you, Nicolette, before we move to the next panel. How do you get the right balance between the board seeking further information and moving forward on those decisions, and particularly not overwhelming management with just further and further requests for more information? How do you determine that right balance as a director?
Yeah, I think it is tough, and particularly tough in this environment. The one thing I'm very conscious of, particularly in life insurance, we've got this perfect storm. There is so much the regulatory side, the disability income, protect your super, large transactions, big. So I do think as a board, we have to be very careful about what we ask management teams for in this scenario. The one thing we do at Zurich, which has been very useful, has been to run these workshops before having a sort of technical sign-off at board level. And I think that is actually very helpful. And so they hold it a few days before, and it's a way of educating the directors, as well as giving the directors an opportunity to ask questions and, what might be seemingly dumb questions, and also just give a little bit more time to think things through. And, it doesn't become a rushed board item. So, for example, the last one we had was on an ICAP workshop. And so I do think that is a good way of allowing time to make sure that you feel informed, that you've had time to challenge things, but you don't have multiple directors all asking for different things and overwhelming already, quite stressed management teams.
Great insight, thank you. It's a really difficult balancing element. Okay, thank you very much to Duncan and Nicolette. We'll bring them back a bit later in the session. Right towards the end, we'll have further Q&As. So thank you. And now we're turning to a panel discussion, also chaired by Ian, with an esteemed group of senior industry leaders, actuaries, CFOs, CROs, and we will also have our second poll. So let us now welcome Ken Griffin, who is the CFO at MLC Life and a non-exec director at Hume Bank, Tim Clark, who is the Global Head of Actuarial for Property and Casualty at Swiss Re and previously Chief Actuary at IAG. Andrew Matthews, an actuary at Finity Consulting, working mostly in health insurance. He's also Associate Professor at Monash Uni and a Non-Executive Director at the Stroke Foundation. Winley Toe is a General Insurance Consulting Actuary and Principal at Taylor Fry. Anton Capel is the CFO of Life and appointed actuary at Challenger, and Greg Martin, General Manager of Strategy at Clearview Wealth. So I will pass back to Ian now to lead our second section.
Thank you, Annette. We'll have a really interesting discussion in a minute, but I just want to show you a couple of slides. You recall the conversation we had earlier about the three horizons, which is generally a well accepted sort of concept from a management point of view. I just want to share a couple of slides with you. Now, can you see that okay?
Yes.
Okay. So think of short, mid and longer term perspectives. If you're sitting here in the short term, it doesn't matter what you're looking at, whether it's asset values or liability values or capital, there's a degree of uncertainty around the value that you might place on that particular item. As you look further into the future, that range of uncertainty and risk widens. And when you look out into the longer term, it's wider still. So this is sometimes called, an expanding funnel of doubt or uncertainty. And it's a fairly well understood concept. But of course, in a COVID world, in COVID conditions, these ranges increase, these ranges here can increase quite substantially. So scenario planning will certainly help understand that risk and uncertainty, but real outcomes, of course, will be what they will be. So if you look at this, and if you think about this being the actual outcome, and you've now got a new short-term perspective, it's shifted. Whoops, I beg your pardon. I've just lost my screen. Let me start again. So when you've moved forward into the future, the actual experience will reposition you, and you need to rethink the degree of uncertainty, the degree of risk that you're then facing. And in a COVID world, this needs to happen fairly fluidly because the world is really changing under your feet. So that's the important sort of backdrop to give a bit of context to some of what we'll be talking about here in a minute. Now, imagine I'm an insurance Ned. I'm diligent, I'm experienced, but I'm worried. I'm a little bit nervous about the situation the company is in. And so the question in my mind is, what do I need to be alert to? And that's really what we're going to talk about here now with the rest of the panel. So if I can start with you, Tim, please.
Yes.
And I know you and some colleagues have been working on ICAP, and you've recently produced a briefing note for the profession. So could I ask you to talk to ICAP generally, particularly in this world we're in? Thank you.
Yeah, I certainly can. And as we all know, the ICAP is really the relationship between your capital requirements and the financial risk of your entity. How you use your ICAP through the crisis and how you assess it as fit for purpose is the subject of the note, as Ian mentioned, that we've recently issued, and you can get from the website. I think, Annette, you'll put it up afterwards where the note sits. The note does contemplate that many entities will want to be using their ICAP in conjunction, as we've talked about, with a dynamic scenario analysis, where to manage its liabilities, its assets, its current and future capital needs. And this dynamic scenario analysis is really a process of thinking through the range of potential futures that the company may be exposed to, what risks, strategies, business plans would be relevant within each of those scenarios, and hence a scenario-dependent capital need, and then morphing it as it goes. In our view, directors should play a really active role in the governance over these scenarios, over the generation of them, over the monitoring of them, and how you might move as the experience emerges, which scenario are you going to put more weight on, and the activities underneath each of those scenarios. Organisational agility, when you're using scenarios, is going to be a really important asset for your entity. As Ian has just highlighted on the slides, there's a really wide range of potential futures we're looking into, and these can have quite significant impacts on your organisation. For example, as we've said, the liabilities that are dependent on the length and the strength of the recession. You may be subject to contractual challenges from AFCA or other interested parties, your cash flow patterns because your customer behaviour, because the markets, because the size of your liabilities all change, so your cash flow patterns won't be stable. And I guess one of the reflections we had as we were drafting the note, boards really need to help management in acknowledging the uncertainty in which they're working. And Nicola, you mentioned that, which was good to see, so that when management are presenting the range of actions and activities, you as boards and NEDs kind of acknowledge the uncertain environment that they're in, because that will help management actually take a bit more action. The note steps through the scenario governance and communication ends, and then provides lots of detailed consideration that should be assessed under the 4 key kind of steps of an ICAP process for each of those scenarios, be it under the business objectives and the risk profile in scenario A versus scenario B, the current capital position in scenario A versus B, the capital forecasts, and the capital targets and buffers. And it's really important, again, the uncertainty, quite different outcomes for even the current capital position is not as certain as you would have taken an equivalent capital position from 12 months ago, because of that range of uncertainty that we're looking into the future. So really all I wanted to say, because lots of the questions that you as NEDs might be considering are actually articulated in this document. So we're encouraging you to delve a bit deeper into it. And with that, I think, Kent, you're going to take us further, but Ian, I'll hand back to you.
Okay, thanks. Thanks very much, Tim. And that note will be available to non-members in the Institute's Pandemic Resource Centre, and I think we'll have the link to that at the end. So Kent, if I can turn to you, how should I assess the capital strength and sufficiency in the current environment?
Thanks, Ian, and afternoon, everyone. Yeah, look, it's an interesting question, Ian, because I think Nicolette actually made this point quite well, is that when you're looking at, in the current environment, things like ICAP and RAS, we have all these frameworks, but sometimes we're using them not necessarily as we might have thought we used them when we put them together. And so I think when you're assessing capital strength, you come back, we're all familiar with the concept of target surplus or target capital. And I think this remains the starting reference point. So this concept of a target buffer for excess assets above regulatory capital, which I expect is a core element of all the existing ICAPs for companies. Given the events of the last few months, and I guess particularly as the point you made, the uncertain outlook, the first step is really to come back to that target and check that it remains appropriate for the circumstances. I mean, APRA indicated back in April to banks and insurers that they need to take a prudent management action on a preemptive basis to ensure confidence and capacity is maintained. And as the situation evolves from here, and given the high level of uncertainty, you've really got to have a benchmark against which to continue testing sufficiency. And that testing needs to be frequent. And so target surplus can provide that baseline against which to assess the strength of the organisation. And then it flows, as Tim's talking about, into scenario and stress testing, again, as that benchmark for sufficiency.
And so what should directors be looking for in reassessing their internal benchmark?
Yeah, look, I'd probably look at that, or suggest looking at that in sort of almost three categories. The first one is really the environment itself. This is the obvious one. So we're obviously, in terms of excess assets, we're seeing assets move in the market. We're familiar with the current volatility of investment markets. As businesses play out, we see changes in revenue, changes in expenses, changes in claims that impacts us. And then obviously as the experience emerges, the liabilities themselves can move, and as assumptions change, can move in a step manner. So that's very much the external environment coming into play. I also think there's a second area, which is the business itself. Businesses are going back at the moment and re-looking at their strategy. They are looking at their risk profile. They're looking at their risk appetite. And they're not necessarily looking forward in the same way as they were, say, 6 months ago. And those elements in themselves, the internal change of the way the companies are seeing the strategy and the outlook, that in itself can change how you want to position your target. An obvious example for that, even outside financial services, is simply in cash and liquidity. There's a lot of companies who probably 6 months ago were much more comfortable running lean on liquidity than they might be today. And then the third one is a point that I think has been made in a couple of forums, which is a lot of our ICAP work in the industry was done over the last few years in a relatively benign environment, as it's been put. And one of those underlying assumptions is your ability to access capital. And for insurers, this can be through tier 1, tier 2, but also it can be in the form of reinsurance if you're looking at capital support or risk transfer. And I don't think, in terms of the level of uncertainty we've got over the next year or two, you can necessarily take those with as much confidence as we could say 6 months ago. And that in itself would go back to assessing your target. Yeah,
so that's a very good point. I mean, capital sometimes simply isn't available. It might be in your ICAP, but sometimes you might not be able to get it. Okay, so should the policy itself change?
Look, in principle, the policy is an outworking of your strategy, your risk profile, your risk appetite. So to the extent to which you're revising those, it's worth looking at. But I think it's quite interesting. I mean, a lot of target surplus policies can be built up, as a sort of 1 year sufficiency test relative to some sort of probability of ruin. And then there's a methodology that sits behind it, which your actuarial financial area puts together. And that can have some relevance, but I think in many ways, when you look at how policies are being done, it's sometimes difficult to sort of place them. So right now, how does that make sense? So I think the more important point is the target actually ends up coming up with a buffer. It's an amount of money. And the real question is, how do you stress test that to whether it's going to be resilient? And this comes back to Tim's point about scenario analysis and stress testing. Whatever your dollars are, how many scenarios am I actually going to be able to run where that actually is enough? And then probably more important to directors, what are the scenarios where it's not going to be enough? What's that trajectory going to look like? And what are the things I should be looking at to get advance warning of that as it emerges?
Yeah, I mean, scenario analysis has the great advantage of being practical and understandable. Yeah. So it is a very powerful concept. Let me turn now to Anton. How do we adapt our ICAP to be relevant in this environment, Anton?
It's funny, sort of standing back and thinking of probably the last big crisis. So heading into the GFC, use of risk appetite statements and risk management frameworks probably a little less sophisticated. And one thing that I'd observed is that companies had probably started to tilt, or a number of companies had started to tilt their frameworks to be more profit-focused than capital-focused. GFC comes along, and a number of companies found themselves genuinely sort of threatened, that their viability was threatened. And all of a sudden, focus on profit goes out the window, and everyone's purely worried about remaining viable and ensuring that they have enough capital. I think the way that the industry has developed over the past 15 years, with greater focus on ICAP, companies developing recovery plans and so on, I think that lesson has been learned, and that companies do have I guess a better appreciation of the importance of capital and a more balanced view to how they set their risk settings. But the reality is that a lot of that work has been done post GFC through relatively benign times, and no matter how sort of diligent you are in stress testing your processes, it's one thing to go through theoretical exercises of how you would react in a bad situation versus actually living one in real life. So look, I would expect that most companies have probably learned something in the past 2 or 3 months that they hadn't fully appreciated sort of going into the crisis. And so I think there's definitely value in undertaking a review of your risk appetite, your ICAP, and how you set your risk profile.
And is it worth spending time right now on revising your ICAP, or is it too early?
So we had a discussion about that as we were preparing for this session, and some people were of the view that it's definitely too early, that we're sort of in the middle of the crisis, and you don't really have the luxury of standing back and analysing how you performed. I think that's going to be a question where the answer will vary from company to company. But I would say that we've probably had enough time now through March and April where companies have made a number of decisions, that there are enough sort of data points that where companies think they do have the capability or the capacity to stand back and look at their performance, that they would have something there that they could analyse and learn from.
Yeah. And so what sort of review actually cover?
I guess you can get into a lot of detail or almost as much detail as you want, but I think probably the greatest value would come from sort of asking two relatively simple questions. The first one being, in the real life crisis, did we act as we would have expected to act under our ICAP? Your ICAP probably didn't exactly articulate the COVID-19 crisis, but we've almost all of us will have run narrative stress scenarios that would have looked in some ways similar to the financial aspects of the crisis we just experienced. So you should be able to tell whether you did behave as you would have expected to behave if you'd run COVID-19 as a test sort of before the event. If the answer is no, we behave differently, then that obviously prompts a review of how you set your risk appetite and how you set up your ICAP. But even if the answer is yes, we acted exactly as we expected, then you can probably assume that the outcomes were largely in line with what you expected leading into it. the second question becomes, if those outcomes, you thought those outcomes were acceptable given the nature of the scenario when it was a theoretical exercise, do you still think it's acceptable now that you've gone through it in real life? And that I think comes down to a risk appetite question. So if you, as Ken said, if you start to change your risk appetite, that has flow-on impacts to your ICAP.
Okay, just before we go to question and answer, we'll do a very quick poll on those 3 horizons. So if you could put that up, please, and if we could have you answer those questions, and then we'll see the answer in a minute. Can we put the answers up, sorry, please? Okay, that's really interesting, isn't it? Thank you very much. Annette, can I hand to you, please?
Yes, so interesting, those results. And I guess those that have got the short term well in hand have got a big opportunity if they can concentrate on that third horizon. Easier said than done. Okay, a question first to you, Tim. Operating across different markets. So has the mark-to-market accounting for assets for Australian companies put Australian companies at a disadvantage, and is it creating more volatility for Australian companies?
That's a really interesting question. The Americans would have a very different answer to the Australians on the mark-to-market. They don't like it. It's hard to say. So far, if you look at the big picture, the Australian companies have been able to raise capital relatively easily. And my understanding is in the rest of the world, I actually don't know how easy it has been in the rest of the world. But it might not be a mark-to-market issue. It might actually be how well Australia's managed the pandemic. And we, around the world, it must look like we're sitting probably in front of the curve relative to most others. And therefore, the domestic economy is probably going to react better than you might see in Europe or you might see in America. So I can't really give a detailed answer to that, but that would be my quick lens on it.
Yeah, I guess every country is dealing with, medical and health issues and then economic, and at least Australia's and New Zealand.
A couple of social issues in America as well.
Well, yes, that's true. And they're pervading the rest of the world too now. Okay, final question before we move to the next session. For you, Kent, a great quote from Andy Grove, very topical in today's COVID crisis. Bad companies are destroyed by crises. Good companies survive them, and great companies are improved by them. You spoke about looking forward. What are the key elements companies should be concentrating on as they do look forward to coming out of the crisis? Kent?
I think this is a great question.
I'm
not sure I'm going to do it justice. Look, there's 3 things that come to mind for me out of this, and maybe there'll be a different 3 if I reflect on it later. I actually think one of the best learnings out of this, and someone mentioned, I think it was Duncan and Nicolette talked about how productivity and things. I've been amazed at how resilient and adaptable people have been, particularly in March when we went from 0 to 100% in the matter of a few weeks. Crisis management teams, sorry, that's my dog in the background. Crisis management teams were activated, and the pace at which we were able to do things, but in a calm and structured and ordered way, has been very impressive. And it's interesting, when we're in normal times, I think things take a lot longer and they often seem to be hard to do. And in a crisis, you get very focused. So frankly, I think one of the great things that we need to learn out of this is how to keep that level of focus, in normal times to really cut through to it. I think the second thing is the focus on customers, on advisors and trustees. I'm talking from a life insurance perspective here, but I think the comment's more generic. There's been a lot of focus in Australia, and I think in other places, particularly in Australia, in during this crisis, of just how interdependent we all are, and the questions around how do companies part they work with, and how do we get through this crisis. And I think bringing that to the fore is part of any great company, and being able to harness that and keep it when we come out the other side. And then the final thing, I mean, it's a fairly obvious one. I think we've all just, it's a very good reminder of, we put all the frameworks in place for things like ICAP and risk management and all those sort of things. But when you come back to an insurance company, it's a very simple thing. We take people's money and we make them a promise, and our ability to deliver on that promise is the strength of our balance sheets, the strength of our organisation, and the role of all those different pieces in the framework and how you bring them together to ensure that you can survive and continue to meet those promises is just critical. People are depending on it. So for me, they're the three things, but I'm not sure if that does the question justice.
And if you're on mute, I think.
We can take forward. Ian, back to you for the next panel.
Okay, thanks very much. So the next section for our panel involves risk, uncertainty, and opportunity. So a somewhat different perspective. And we're going to start with Greg Martin. Greg, in conditions of stress and uncertainty, such as what we have at the moment, of course, risks change. They get bigger in some cases, they maybe get smaller in others. And sometimes that's really quite significant. We also see changes in correlations between risk, which is a really interesting issue. And so, for example, financial issues can lead to operational issues and vice versa. So in this environment, what are some of the key risk directors should now be thinking about? What, as that executive, non-executive director I referred to before, what should I be alert to?
Thanks, Ian. I think the comments you just made, are sort of well-known doctrine, if you like. Correlations move things from out at Pluto suddenly become big when you have a stress event. I think some of the things we've also seen at the moment that perhaps we didn't think about so much in some of our risk modelling is the way that risks can completely morph in response to the way, for example, governments have reacted. So I think Nicolette was talking about this before. We start off with a pandemic and we find ourselves in an operational economic scenario instead. So what do you think it is? I think we're also seeing now some of the secondary effects of some of the actions we've taken, and I'll come back to that a little bit, that I think directors might like to think about. And one thing I think we have touched on a little bit, but already is around, well, in Australia, recent phenomena like community expectations, or overseas, I think there's what they might call social insurance in inverted commas. I don't know that we fully allow for some of that stuff in our modelling that we've done to date. So that's just and how that works in the stress environment. Look, there's 100 different risks that we could talk about. I think I'll probably just try and, and a lot of them has already been covered in the last couple of sessions. Woe be an hour and 10 minutes into a 90-minute session on risk and trying to come up with something new. But look, 3 areas I think directors should be I would underline that just at the moment, that whole community expectations thing, and really thinking through what the consequences of that's likely to play out over the next 6 or 12 months. Risk exposures and things that are happening as a consequence of what we've done, for example, work from home. And the last one I just underline is exactly how good some of our risk mitigation strategies that we think we have, how strong they are, and whether we should actually be going back and just having a little look and think about those. There's a lot of assumptions under our risk mitigation strategies. Some of those are proving to be a little bit strained. So if I could just give a couple of quick examples of what I'm talking about. First one would be business interruption insurance and pandemic exclusions. I think that's already been touched on. Overseas, this is becoming a bit of a global, it is a global issue and it's starting to get quite serious in some other jurisdictions. this idea of social insurance, that notwithstanding that you have an exclusion, the insurers should just pay the claims anyway. I have seen some numbers, or heard of some numbers rather, last sort of 48 hours, suggesting that if pandemic exclusions were put aside in the US and they were required to pay on business interruption insurance, it could run at something like about $300 billion a month of claims, and the whole industry would not be very in good shape in a very short space of time. We haven't seen quite that same approach in Australia, but definitely I'm understanding that in general insurance there is some question around whether some of our exclusion wordings are all that they could be, and there has been some suggestions I've heard around potentially some large-scale challenges around some of those. So I said the assumptions that underline some of your risk management mitigation, I just think we directors really should be looking at that. The flip side of this is, of course, is with community expectations. If your pandemic exclusion is bulletproof and you're not paying claims on business interruption expense, well, these days the next question is, should you be refunding all your premiums? Because you're not covering anything. It's a moment of junk insurance. So, I mean, that's, and that potentially extends to other areas. I think somebody else, I think it might have been Nicolette mentioned, where your car insurance claims might be down at the moment. So should there be some, redress, partial refunds? Again, a lot of that stuff just probably isn't even on has not historically been on our radar as things we would model and think about. But really, and some of these go to political issues and whole industry issues that need to be engaged with governments and others and regulators. Second little example is around extending premium waivers. I think the life insurance industry has probably done quite a bit of premium waiving one way or another with customers that have lost their jobs and been a bit vulnerable. A lot of policies already allow for 3-month premium waivers. What's going to happen in the next 6 to 9 months, 12 months as JobKeeper and JobSeeker come off? What's the community expectation going to be around that? What will be the demand, and have we all allowed for that, thought about it, and what are we going to do about it? And the last little example was this, consequence of actions we've taken. Everyone's been talking about staff working from home, how wonderful it is. I will just point out that highly engaged and effective people and those with depression sometimes don't look that different. Mental health and stress on staff working from home and other new vectors. I think last week there was a finding Supreme Court around domestic violence and employer liability around that for staff working at home. One particular area that's just got my mind a little bit exercised at the moment is around our disability claim staff. We've got them working from home. They're going to have increased caseloads coming through with increased disability claims. They're going to have customers who are also under perhaps even more pressure than normal. Potentially not working in an ideal circumstance, and then they're not going to be with their mates and getting the moral support they might get in the office to help them deal with the job. We're going to have a pretty bad disability income experience in the next 6 to 12 months, 2 years. And we may not, we should think about whether our claim staff are actually being fully supported and really going to be on their best game to deal with that, or whether we need to do more. So, look, to sum up very quickly, in new vectors, this whole community expectation, social insurance, I'm not sure whether anyone's really thought through that. Whether all our risk mitigation assumptions are bulletproof, and whether directors and boards and companies should be just thinking about that a little bit more. And the whole work from home, mental health, and the whole operationalisation and effectiveness of that. How's that really going to play out as we go forward? So that's my little hit list. Ian?
Yeah, thank you, Greg. Some really interesting insights there. Let's turn to Andrew, and we're going to morph a little bit from risks to uncertainty. So Andrew, the outlook for businesses in times of stress and uncertainty can become quite clouded quite quickly, of course, from both strategic and operational perspectives. So boards have to operate at present with much higher levels of uncertainty. It's really unclear how this is going to play out. So that's very challenging for a board. As that director, that diligent director, what should I be alert to?
I think, Ian, that one of the things to be most alert to in uncertainty is that bubbles up and we get caught in what I call competing demands. So you see it in the big picture level, lives and livelihoods. Do we lock down the economy to save people's health? or do we revert to the helping the economy and let the pandemic run loose? That's an either or. We need to be very aware when we're caught up in that. And as a panel, we discussed a lot of these and came up with thousands of examples, short-term or long-term, you know, customer or financial, ASIC or APRA has come up in the Q&A. So we thought rather than just talk about each example, the best way to deal with these is to try and come up with some simple rules that will help you navigate through a problem. So I'm not going to preach simple rules to everyone because it'll be different for every company, but I'll give an example, right? So, and simple rules, if you've got more than 5, you've probably got too many. So I'll try and come up with 3 principles, and then I'll ask Winley to test it on a health insurance, on a travel insurance question. So principle 1 would be, let's surface the assumption. Let's see why we're being asked this. And really, if you're being asked an either or question, surface that and question, why can't I do both and? So do both and, avoid either or. Principle number 2 would be, what are my guardrails? Sometimes we couch it in technical terms like, what's the risk appetite? The guardrails might be, I don't want to harm the customer, but I don't want to harm the financials. And there's a space in the middle there, I'd call it the brave space. So a question that you should ask is, where are my guardrails? Because then once we've established those guardrails, you can move to principle 3, which is make a choice. So, you know, Duncan talked about earlier, you know, the risk of inaction. You're not going to take the perfect action, but if you've got the guardrails, you've got an ability to make a choice and adapt or avoid paralysis by uncertainty, which I think is one of the biggest risks to be alert to. So I might ask Winley if you just want to talk to that travel insurance example that we had when we were debating this.
Thank you, Andrew. I tested this case against Andrew's 3 principles. So you all know that travel insurance is the class that's been hardest hit by, well, general insurance class that's been hardest hit by COVID, and everything like ground to a halt when the borders closed. But yet it was in this adversity that I took greatest heart in both my fellow humans and in our insurance industry. So right near the start at a board meeting early on in the pandemic was a pretty robust discussion between the CEO and the board around what to do in relation to people who could no longer travel but because of the pandemic exclusions, they were not entitled to a claim for their cancelled holiday plans. So the CEO started the discussion with, what's the right thing to do by our customers? And ended up advocating premium refunds. So yes, the flip side of that is it impacted their financials and their cash reserves to weather the lockdown, and even the CEO's own position. But his premise was, what is the point of protecting your dollars if you lose sight of your mission to protect people? So, I mean, the decision I think here was not straightforward. From a legal viewpoint, it wasn't clear cut. There was nothing in the PDS talking about providing refunds or anything like that. So in the end, the decision was made by board and CEO to even ring up customers who hadn't asked for it to offer refunds or deferrals of cover without penalty. So what was heartening here, I think, is the leadership's thinking in this order. What is the right thing to do by my customer? And then only, how can our financials support this? Because what's the point of surviving, you know, if you're not doing the right thing? So in any case, the end of this story is that AFCA recently released a guide that states that refunds are a fair outcome in the circumstances. But this company was on the front foot and did it from the start without needing a push either from AFCA, a guide, or angry customers. So I think this is a simple rule, I think, that would serve it served me well when faced with uncertainty. But I preface this with, in an insurance context, of course, it's important to refer to your mission statement, your constitution, as earlier speakers mentioned, important tools like your risk appetite and your ICAP. But I think my simple rule when faced with uncertainty in all the balancing and guardrails and so forth is really to do what's right.
Thanks, Winley. And look, risks and opportunities, of course, are sometimes flip sides of the same coin. And we've spent a fair bit of time on risks and uncertainties and managing the things that can go wrong. But talk to us about opportunities.
Okay. it's fantastic. I get the opportunity question, I think, after all the doom and gloom and talk about risk and uncertainty and survival. Because I think where there's enhanced risk, there's always enhanced opportunities. Because I think what better time is there to act for us in the insurance industry than now? We've got really, really engaged customers. We've got really vulnerable people, vulnerable customers, vulnerable staff who are looking to our collective skills to help them through this crisis. So I think it's natural in a crisis for our attention to focus on the short term. But I think boards and management should give as much focus today to the long-term strategy and on things like life and opportunities beyond survival. The pandemic will pass, believe me, even though we don't feel it now. And the companies who come out ahead, I believe, will be the ones who are already considering opportunities arising from the circumstances we're in now, plus the opportunities post-COVID. So I'll give one example, telehealth. Some of this would have taken years to negotiate, and yet in this crisis, we've got it working in weeks. So one of the workers' comp insurers I work with was telling me how great it is for some of their remote workers getting treatment through telehealth. She was saying how she's seen some of the men, it was men that she mentioned, sorry, men on the panel, get completely worked up when asked to come into the city to see a doctor, so much so that their anxiety overwhelms their treatment. Now they can get help through their iPads at home. How good is that? You know, so I think great ideas can gain momentum in hard times, and that's when I think that's because we have this collective focus to solve something. The other thing I want to add to what Kent just said is really, I'm really heartened by the ability and pace of change. I mean, one of Commissioner Haynes' criticisms in the Royal Commission, and sorry, Commissioner Haynes, if I'm paraphrasing you, is how it took so long to get anything done. But what the crisis has shown us, that with our collective skills and wills, we can achieve anything. I mean, imagine, I would have been laughed out of town if I suggested, you know, shifting thousands of workforce to working from home successfully, as, you know, Nicolette has mentioned, with you know, productivity increasing and so on, you know, without 18 months of change management and planning. So I think boards and management can take this change mindset to other things. And I'm sure we can all think of a million other opportunities, cyber risk and so on, but maybe let's just pick customer remediation as a possible focus. I mean, we can do it right, we can do it empathetically, but what this mindset has shown us is that we can do it now. So thank you.
Yeah, thanks very much, Winley. They're great thoughts. Annette, can I hand back to you, please, to take the Q&As from the audience?
Sure, thank you. So thanks to all the panelists, and there will be some questions on the last group of panelists as well as to all the speakers from today. So can I start with this question, and I'll start by asking Duncan this question. COVID-19 represents a rapid and consuming crisis and has received an urgent response. But how do we effectively deal with other boiling frog crises that take longer to evolve, such as climate risk and arguably disability income insurance? So what are the actions that we can learn from this particular crisis in terms of how we deal with those bigger questions?
Yeah, look, I think boards have multiple.
Duncan, can we see your video, please?
Yeah.
Thank you.
Come back on video.
Thank you.
So boards have multiple issues on the go, as do executive teams at all time, and you know, they will all have different paces of development. IAG has been very proactive on climate change, for example, for a very long time, probably going back 2 generations of leadership. So, you know, these take time to develop. They take time for the issue to evolve to maturity in the community and at government level. So I think what we see on some of these issues is business leading the politicians, or moving ahead of the politicians, which I think is something that businesses can do. Because we get it, you know, we understand the reality, and we're not constrained by just the political dogfight that goes on.
Thank you. A question for Anton. Now that we've seen that ICAP has been pretty useful through this process, what are the lessons that we've taken over the last few months, and how can we make it even better?
I think just being prepared, having sort of thought through how you would respond in different situations, going through test exercises to say, this happens, we do this, thinking about what are the implications of doing that. That's been the value of having a robust ICAP process in place. I guess what we've been through is a real life example that gives you greater insights into what the implications are of different courses of action. And so, use those learnings to refine your processes. But otherwise, more of the same. Continue to test. Continue to think through the consequences of different courses of actions, and continue to sort of get yourself comfortable that the sort of range of the response options available to you do actually let you live with the outcomes of different potential scenarios.
Thank you. A question for Win Lee, and then if Andrew and Greg can also comment on this. Surveys have shown that through COVID times, super funds have actually lost customer trust while the banks have regained it. Do the panelists think that insurers have gained public trust through this process, and what more can we do over coming months to ensure we're well positioned to support our communities? Winley?
Oh, it's hard to answer to start with, but I think if you judge by the number of complaints or COVID complaints that go through AFCA at the moment, over 1,000 to date, then perhaps you'd feel negatively about it. But I think when people make complaints like this and it's resolved satisfactorily and we're transparent about it, then I think that we regain people's trust as a result. I think it's a gift when people take the opportunity to complain to you and you can act on it. So I think that we've got work to do, but it's a question of being transparent, being honest, and doing the right thing.
And Ed, I'd probably say, this is an opportunity, the crisis, for the industry to actually regain some trust. And I think we should all think very carefully about how we do that. And as to some of the points that, Win Lee was making before, it's about actually being preemptive on some of this stuff. Even if it costs us a few dollars, in a couple of years' time, we may think it was a good investment. So, the community expectations thing is, it is a risk, it's a downside, but it is also an opportunity. Get on the front foot. And I was saying before about what we're going to do with waiver of premiums in the next 6 or 9 months. We'll maybe get on the front foot of it, and that's a way to rebuild trust and community respect.
Thank you. And Andrew, any final comments that you'd like to add?
The final comment I'd add is, it's a great question, and it should be asked directly to the stakeholders. So the only people that can ask that is, do customers trust you more? Do stakeholders trust you more? And too many boards and management are sitting around making assumptions about that and not getting out and asking that question.
Okay, thank you. And to our audience, you've seen on your screen now that we do want to get our own stakeholder feedback. So please do take a couple of seconds to respond to how useful you have found today's webinar. And while you're doing that, I will ask Ian to wrap up with his pearls of wisdom. He's obviously got many, many years of experience across multiple markets, in commercial and in regulatory roles, right across the industry as an exec and non-exec. So Ian, what final pearls of wisdom would you like to impart to our audience today?
Just a little anecdote, I think. In the early 2000s, I was working in the UK for companies that had a number of companies that had significant financial stress, and in an environment which was extremely difficult. So personally and for the people around me, it was very difficult and it was very stressful. But rather perversely, I look back on that period as one of the really great and interesting parts of my career, and often reflected on that and asked myself why. And I think one of the reasons for it is that you have to deal with many, many different issues, and you learn very, very quickly. You have great experiences, you learn from those experiences, And I used to say to the team of us who were managing through this business, this is tough, but you'll never, ever forget it. And you'll learn so many things during this process that you wouldn't learn in the normal day-to-day running of the business. So make the most of it.
Thank you. Thank you to Ian and Duncan, Nicolette, Kent, Tim, Andrew, Winley, Anton, Greg, and thank you to all our participants. The video today will be available on the Actuaries Institute and the AICD websites. And we're just about to show you the links that are available on both websites on their COVID resources as well. So thank you very much to the collaboration by the Actuaries Institute, AICD, and all have a wonderful weekend. Thank you.
Thanks.
Bye-bye.